So I wanted to say a few words for the 3 upcoming panels and how they are organized. Just like you out there, some of our speakers will dial in. Traditionally, the first panel deals with monetary policy, but not in the form of a press conference where the president deals with directly the questions of the day, but taking a bit of a longer strategic perspective. And traditionally, the person with the chief economist role, as we call it, on the board does that. So Philip Lane will do that. We will have 2 speakers. He will actually be in a situation today to have to dial in. So he will be sharing online. Then we will have Stephanie Schmitt-Grohé from Colombia, who will also be with us virtually. And we have Ricardo Reis, who is with us today. So in a moment, I think, when we get started and everything technically is prepared, so we're a little ahead of time, but that's good because we have the tradition of being behind. So it's good. Some people remember that, right? You used to be pretty bad sometimes. But so we're a tiny little bit ahead. So that gives me a moment. But in a few moments, Ricardo, I think we move over there. We will both sit there, and then we can easily be understood. And then, Ricardo, when it's your turn, you can speak either from here or you might be able to speak from there. But maybe it's easier for the videos and everything to do it from here. So that's the panel which will deal with the kind of multiple policy questions. And let me say one thing, so then I can give Philip Lane more time later. But so one thing, when we talked about the topics, I had thought of, okay, let's do the session on exit. And then Philip said, maybe I can say that, oh, I think by that time we will be in the exit. So talking, and his view was by then, at that time, we will have announced that we will end the PEP program, at least in some form. And then we got that information in December, and now we got substantial more information. So at that time, I said, let's expand the title and we say, after the Corona crisis and new challenges. Right? Of course, at that time, we didn't think the challenge would involve what we have now, namely, as President Lagarde pointed out, already a further supply shock, increase in inflation, possibly more negative outlook on growth, but also the risk of getting even more of that. So I think that title captures it very well. We will, of course, we have chosen the titles very broadly, so we will be able to fit in a whole range of the issues already raised now regarding the risks coming from the Russia-Ukraine war. After the lunch break, we'll have a session on what we call then multi-policy and climate change. I think after many speeches and many discussions to which Isabel Schnabel, our speaker from the ECB side, contributed importantly, we might have thought that many of the issues had already been laid out. But I think the whole question of energy security and how climate change and climate protection policies factor in has acquired a whole new dimension. We will have Isabel on location, Monica Piacesi from Stanford dialing in, and Hans-Peter Grüner, who's already sitting over there, also here on location. And then in the afternoon, we will touch on the multi and fiscal interactions. I think they are very challenging. We've already thought about many of the questions, both what could fiscal policy be doing? Of course, before the war started, we were thinking, or I was thinking primarily of consolidation, maintaining fiscal sustainability, and that is still an important element. I think at least we will have the question of strength, which involves fiscal sustainability, but also, of course, the application of the fiscal rules, reforms, and also how that factors in to multi-policy and keeping multi-policy free to act as it needs to do to maintain price stability. We will have Ignazio Visco from the Italian Central Bank as a speaker. He will be with us virtually, so he will be shown here. And we will have Harry Stellas and Philippe Martin, who will both be here discussing these questions. Now, before we now bring on the speakers, some technical remarks. Each panel will be first the 3 panelists, 10, maximum 15 minutes, maybe a little less than 15, that leaves more time for questions. Then we have 4 or 3 first questions from the people very engaged in the community of ECB watchers. So we have a few seats here with mic. So we will first have these lead questions, and then we have questions to the audience. We will either bring you the mic or you can step up to the mic, but I think the easiest will be to bring you the mic, so you just raise your hand. We will also have the option to have questions from the people registered for the live stream. It's not a wide public live stream, it's only the people registered, and you can join with questions, and Mr. Lehrmann, you can explain me, they will show up on the screen. We will try this during the first panel when I will be the chair, and Ottmar Issing and Daniel Gross, who will respectively chair the subsequent panels, hopefully will do that too. So we will hopefully engage every audience, and the speakers will be disciplined enough so that we actually have sufficient time for that. So without further discussion, thank you again. Now I think, Ricardo, let's move over there. We see if Philip is already online. We'll check that. It's a little bit early, Philip. Yes, you're there. And I think Stephanie is there. So in a moment, let's get started. I'll just move also over to this desk. So thank you. This allowed me already to discuss all what's coming up. And also the kind of ground rules, how we're going to proceed. The only other thing, since I'm the chair, so my last task when I can kind of breathe and relax a bit more, is after this panel. So the only task left to me as chair is to watch the time and to quickly introduce our speakers. I mentioned the names already, so I can say a few words still to the people we have. First up will be Philip Lane, who's joining us. He's already there. You can see him. And Philip Lane, of course, in his role as chief economist, plays a key role in setting the agenda for the meetings, at least the monetary policy perspectives. And he's also someone who's been on the board for a long time, first as governor of the Irish Central Bank, now at the ECB. So he brings to this a lot of experience already in monetary policy. Of course, I think the last time we had such a change, of course, when policy went back to tightening is even longer ago, almost. So it's challenging times. At the same time, Philip is someone very well known to us because he spoke earlier on the conferences. As an academic, he was very well known for his research in many areas of macroeconomics and international economics. He also got his PhD in the US and has a lot of experience on both sides of the Atlantic, another feature that I think is again very important in the current situation. So Philip, I'll give over to you in a moment, but let me say also a few words about the other two speakers. So Stefanie Schmitt-Grohé, which I believe she can also follow us right now, right? Can I ask the technical team? She's probably there. All right, I hope to be, that's the case, good. So Stefanie actually started out at the, oh, there she is, hi. She started out at the Fed at the same time I started out there, or no, or a year ahead of me, I think. Either way, I forgot, but we certainly shared some time there in the Division of Monetary Affairs. She had an illustrious academic career afterwards and is now at the Columbia University. Of course, when we talked last year, she was also involved, I think, in commenting on in the context of the ECB strategy review. One of the issues was also your research on the neo-Ricardian approach and the kind of question, how do policy decisions actually affect inflation expectations? Does it, of course it's difficult. There's a short-run effect and a long-run effect. We have probably more confidence on the long-run effect sometimes. But there are many other areas, your work on sudden stops, on international macro modeling and multi and fiscal policy, and on expectations, all that is going to be important for where we are at now. So I'm looking forward to your contributions to this discussion. And finally, we'll have Ricardo Reis, who's not with us the first time. He hails from the London School of Economics, originally from Portugal, and he's spoken to us repeatedly over the years on multi-policy. And as we last discussed today's panel, he also shared how much the demand was, and he's very active on Twitter, I understand also, the demand was in understanding the effects of demand versus supply shocks, and in the current crisis, how a war will affect us, what are the risks. The president already spoke about it. So, Ricardo, fantastic to have you too. So, I've done everything now what I need to do. I just need to keep the time from now on. So, Philip, on to you.
Okay, hopefully this will work this time. So I think that was in honor of St. Patrick's Day, because of course Murphy's law says if something can go wrong, it will go wrong. And we had a perfect video check yesterday, but of course on the day is always different. So, and the magic, by the way, of this internetclicker.com means I can control the slides, which are in Frankfurt from my iPhone here. Okay, so this graph is really the start of what we need to think about. It shows you in blue headline inflation, in yellow core. And, you know, as the president was explaining earlier on in the opening speech, you can really think about this graph in several ways. You can go back to pre-pandemic, and you can observe that essentially headline average, you know, just around 1%, in fact, slightly less between 2015 and the pandemic. And core was quite sticky around 1%. So before the pandemic, we had this fairly substantial shortfall compared to 2% in terms of inflation performance. Now, what we've seen, and let me emphasize again fairly quickly, this is only really since the second half of last year, is this really big increase in headline inflation. And this morning, the February number, which was a flash. So let me just, I'll assume you can hear me. We had core was around 1 and has also moved up in this period. And is currently various measures of core are above 2. So you might say, well, that's a significant move. But what we also think, according to staff projections, is a lot of the high inflation is temporary, and over time, some of these level effects will fade away. But maybe the most fundamental issue is, instead of fading back to the pre-pandemic numbers, the projection is inflation will fade back to basically the 2% target level. So this graph is conveying quite a bit in terms of the move right now. The sentiment, as the president explained, that it doesn't look likely we're going back to the pre-pandemic stickiness around 1%. And this is a very important set of facts to think about. Okay, so one big analytical issue is a lot of the currently temporarily high inflation we think is externally driven. It's basically imported inflation. That can be captured in different ways. The left chart basically just shows the trade balance, which for the euro area was pre-pandemic around 2% of GDP. And what we've seen here is a big decline in recent months. And in fact, the euro area is now running a trade deficit. And you can see from the composition, this is mostly because of the big increase in the bill for energy and food imports. I think an important or useful way to capture that is to think about, well, if I want to maintain the same volumes of imports and exports, what do the relative price changes mean in terms of the overall extra expenditure? And the right side shows you that in the last quarter of last year, compared to a year before that, if all that was happening was the energy shock, it would have been a very big hit to income, terms of trade adjusted income. But I think there are two factors to take into account. One is it's a bit misleading to compare it to the end of 2020, because of course oil prices were low in the first year of the pandemic. And the president quoted the number of 1.4% hit if you compare end of 21 to end of 19. And then second, which is relevant for the euro area, is the global shock also includes a shock to the price of manufactured goods. And Europe, as an exporter of many manufactured goods, including cars, for example, have enjoyed rising export prices for some of those, which is partly offsetting the energy shock. So what this means is, in terms of interpretation, a very important issue is in relation to core inflation is, are there reasons to think that some of the currently high readings for core are basically a kind of indirect reflection of high energy prices and essentially bottlenecks. So let me actually take the right panel first. And what this panel basically says, these are the basic model elasticities from the range of models used by the Euro system, and which allows for a range of lags. So we have to think about the fact that low prices in 2020 are still percolating in some ways, the high prices right now, and then the forecast what prices might be like coming up. And the blue line is the overall net impact in this very basic back of the envelope calculation. And what it says is, around now, that maybe up to around 80 basis points of core inflation is simply the fact that the scale of the increase, which is 32% in the February data, is so big that every sector in the core component that uses energy is basically confronted with a significant cost shock from energy itself. And to the extent we think the energy shock in the end is a level effect, it's not a growth rate effect. As that level effect fades out, as this component of the pressure on core should fade. The left side shows our analysis of goods inflation, non-energy industrial goods. And what that shows there is essentially this a different way of calculating what's going on. Is again, the red bars do say that the energy shock is also affecting goods inflation, but we also have this pandemic effect proxied by the PMI supply indicator. And so if you put those two together, it says around 1 percentage point of goods inflation might be attributable to factors we think are temporary. And then the middle panel is saying in relation to services inflation, that essentially both the reopening of the economy and the oil effect are there in services inflation. So this is again why we think, even though core inflation is above 2 now, there are reasons to believe it's going to fade because of those level effects. Okay, so it's important also maybe to take into account what's going on in a comparative context compared to the US. So this is a core inflation side by side for the euro area and for the US. And you can see these factors are playing a role both sides of the Atlantic. But quantitatively, what we have is core, as I say, temporarily being above 2. In the US data, it looks more like core being around 6. And you can see some of the factors here, probably most important, is basically those categories affected by bottlenecks have had a much bigger impact in the US data so far compared to the euro area data. So this is now where I'm facing a little bit of a challenge with this internet clicker, which is now freezing. So I don't know if on site someone there can possibly move the slide deck along, because now the internet clicker is freezing. Okay, so behind that is the different pattern in demand. You see on the right side, compared to the pre-pandemic level, we've had a big increase in expenditure in the US for durable goods, non-durable goods. Services still not quite at pre-pandemic level. Whereas on the left side, what you see is that the demand for goods is basically recovered to pre-pandemic level. Demand for services still below. So we don't have the demand side of the inflation dynamic in quite the same place in the euro area as in the US. Next slide. Okay, so as mentioned by the president, I mean, a very important anchor for the inflation dynamic is what's happening to inflation expectations. And we look at, every possible measure. Today I'm focusing on maybe the expectations of the people in the room, including the survey of monetary analysts, which basically now has modal values around 2%. And just the right side is just making the point is everyone in the survey is agreeing this year inflation will remain high, but with a strong consensus that basically it should be going back towards around 2% in the next couple of years. Next slide. So the change in a year is maybe worth focusing on here. This is the distribution from the survey of professional forecasters. You can see the mode has moved from around 1/6 to 2%. It's still the case, probably more of the distributions to the left of 2 than to the right. But that's a pretty big move in the distribution in a single year. Next slide. And then if I look at market data, the kind of models run at the ECB show at the one side is a big run up compared to the start of last year. But it's also important to take into account that part of that run up is a change in risk premia from basically a discount to an inflation risk premium. People do want to insure against higher inflation outcomes. So there's still a sizable movement in the expectation that the yellow line, and it's around 2% and nudge below. But there's also been a big movement, which I think reflected in our own assessment of the uncertainty as well. Next slide. Okay, so where are we now? What the staff released last week, it does basically have this feature that we're still have a pretty strong recovery from the pandemic engine driving the economy. And essentially, this is going to mean that growth rates will be unusually higher again this year and next year before going back maybe to a more normal growth rate in 2024. One of the big drivers in terms of the inflation dynamic is the fact that we think the labour market is going to continue to strengthen over this time period. And again, we have a situation where the labour market looks like it will be tighter than we've seen for 40 years. In part, of course, that's not all good news in the sense that it's also reflecting the aging of the European population, less by way of foreign workers and so on. Okay, but maybe importantly, we do think over time the inflation around 2% will be, if you like, domestically driven as opposed to what we have right now, which is externally driven. And in particular, we think wages will be growing around 3%, which is consistent with the 2% inflation target. Next slide. Now, we also in the staff in the projections last week also ran through some war scenarios. Now, it's important to say already that the 3.7 for this year already allows quite a bit in terms of what they could incorporate into the baseline in terms of the initial impact of the war. But the adverse and severe scenarios, essentially think about worse scenarios. It's important to say these are not tail scenarios. These are still fairly limited, significant. I mean, if you go through the assumptions behind this, there are significant hits to the European economy going on here. But fundamentally, it's assessed that the kind of intense phase of the damage is temporary this year, and there will be some bounce back, even if the level does not recover in terms of GDP. And you can see, because the level of GDP is hit, in the adverse scenario, you do see a weakening of inflation pressure, whereas in the severe scenario, that's counterbalanced essentially by, first of all, energy prices are assumed to be a lot higher for longer, and second, stronger second round effects are working to offset the lower profile of GDP. Next slide. And this again, just to emphasize the labour market point, which again is fairly fundamental, is the yellow line is what we thought or feared in June 2020, the first projections after the pandemic hit, where we thought the labour market would look a lot worse for a lot longer. But in fact, as the President indicated, the policy response, and most importantly, I suppose, the vaccines, has allowed the labour market to not only rejoin, in prospect the pre-pandemic path, but to get even stronger. Next slide. So this is why we ended up with this new policy configuration, which tries to take into account the uncertainty we face. So yes, there is a bringing forward of, if you like, the return to 20 billion a month in the APP, which in December was scheduled to happen in October. It's now happening in June. The main reason for that is to basically give us a genuine optionality for the third quarter, because if we're at 20 billion in June, what is written here is credible. Is that if the incoming data support the expectation that the medium-term outlook will not weaken even after the end of the net purchases, that means we will conclude in the third quarter. But equally, since we don't know that's going to happen, it depends on how the data unfold. We are also clear in our state-dependent forward guidance that if the outlook changes and the financing conditions become inconsistent with further progress towards the target, we do stand ready to revise our schedule for purchases in size or duration. Next slide. And then the other way we take into account uncertainty is to emphasize, right now we're focusing on the best timeline for ending, for the calendar for APP. And to emphasize, there's a second set of decisions to be made later on whenever we do end APP. And just to say, there's nothing automatic here. The interest rate increases will take place on the appropriate timeline. And it will basically be driven in terms of liftoff by our well-established forward guidance criteria. And then more generally after that, by whatever makes sense in terms of delivering our inflation target over the medium term. Maybe let me emphasize just in closing here, is we wrote a new strategy, which we published last summer. And my basic point is if you're trying to work out, well, how is the ECB going to respond, not just this year, but in the coming years, just closely study the strategy, all the associated documents, because we did try and work through quite a bit of the best way for us to proceed. Okay, with that, let me stop.
Thank you very much, Philip. I think we go straight through the three presentations, and then start the question rounds. So I would hand over to Stephanie Schmitt-Grohé. I did all the introductions and praise already at the start, so you can go straight.
Okay, can you hear me?
Yes, we hear you very well.
Okay, thank you. Can you also show my slides so that I see them? And then I'm not going to go with the clicker. Yeah, so let's go right away to the first slide. I only brought two. Okay, so this is my first slide. Okay, so thank you very much for giving me the chance to comment in this very exciting forum on ECB watchers. And I thought I would give you my perspective on the ECB's policy and inflation outcomes. And since I'm located in the United States, I thought that maybe some issues become clearer and easier to understand if we compare the euro area with the US. And I wanted to zoom out a little bit more than Philip has. I want to look at the last 20 years. And in this slide that I'll spend some time with, the first row, so everybody is oriented, is the euro area, and the second row is the US. And so if we want to think about the current event, I would include in the last 2-3 years, we had two massive global shocks. The first global shock was COVID, and the second global shock is very recent, is the Russian invasion of Ukraine. So these are two global shocks that are not specific to the euro area, and while they might affect the euro area and the US slightly different, in the big picture, they should have the same effect in the sense that the COVID shock was a negative supply shock, and we should expect that a negative supply shock leads to inflation, and the optimal monetary policy response to a negative supply shock to avoid overheating is usually tightening. And that should apply equally, as I said, since it's a global shock, to the US and to Europe. And we have the Russian invasion to Ukraine, on the other hand, would be interpreted as an uncertainty shock. An uncertainty shock usually is taken to lower demand. It's going to decrease consumption demand by households because it increases the desire for precautionary savings, and it also lowers the demand for investment by firms as uncertainty is higher. And so the response to a demand shock of that type would be for the central bank to actually ease or to cut interest rates. So these are the two global shocks that currently affect both countries. And I wanted to go back a little bit to the last global shock that affected us, which was the financial crisis of 2008. In both countries, the euro area and the United States, as you can see in the left column, quickly eased normal interest rates. And what I want to point out is, or focus a little bit on what happened after 2015. At that point, the US normalized. That is to say, the US started raising interest rates, and the euro area, even though the kind of nominal rigidities that a central bank needs to worry about by 2015 should have disappeared, the euro remained at zero interest rates, or actually at negative interest rates. It reached its minus 50 basis points. Now I want to ask the question, did this easy stand in the euro area between 2015 and 2020 lead to inflation? Because very often there's this idea in monetary policy discussions that low nominal interest rates bring a country behind the curve, whatever that may mean, and that might bring inflation up. And in that episode from 2015 to pre-pandemic, we know, and Philip just stressed that also, that actually the inflation rate of the ECB was 1%, which is 1 percentage points below its target, even though monetary conditions were extremely easy. By contrast, in the US, between 2015 and 2020, the US had lifted off in December 2015. Rates reached slightly above 2%. We see that the US economy had higher inflation than the euro area. And I view this as causal, and they hit the 2%. So that leads me to the next current situation. Not next slide. Sorry, I'm gonna, thanks. We see that both, at least until yesterday, both the euro area and the US still have maximum accommodation in terms of the interest rates. The ECB rate is minus 50 basis points. Until yesterday, the US was at 0 to 25%. Yesterday, the US announced that it would tighten 6 more times this year. And if we look at the inflation outcomes, you see that if we focus on core, in the US, the February number year over year was 6.4%, whereas, as Philip also just showed, in the euro area, it is close to 3%. So one has to ask, what accounts for this different experience? In particular, as I just stressed, that the global shocks hitting those two economies are about the same. Nevertheless, one country, the US, has inflation reaching 6.4%, and the euro has a much lower outcome, not even 3% for core inflation. In my argument, global shocks are the same, and hence the inflation outcome should be the same. So what am I then coming up with as an explanation of why the inflation experience of the US is so different than that of the ECB or the euro area? It gives me it leaves me two directions I can argue. One would be that fiscal policy or the fiscal stimulus that came with the pandemic was different and larger than in the US. I'm not going to go down that road. I think it's a very important part of the explanation, but I've seen that Volker has scheduled a separate section on fiscal policy, which is the third debate. So that leaves me with monetary policy. So is the reason, or can one argue, that the inflationary experience in the euro area is much more subdued than in the US? Could that be a consequence of monetary policy? And I would argue so. The monetary policy in the euro area, as we just heard from Philip, is formulated as saying, let's first stop with asset purchases, and then once asset purchases have stopped, at that moment, we will consider normalization, which means tightening. Whereas the US is in a different state. They tightened yesterday and they announced that they will raise interest rates 6 times more this year, presumably 25 basis points. Suppose we think it's only 25 basis points each time, that would lead the policy rate at 1.75% by the end of the year, whereas for the ECB, we think it might still be a 0. And another one way of, okay, so what is the difference if the policy rate is much lower? And my argument is that if the policy rate is lower, that will not make inflation in the euro area higher, but by contrast, like what we have seen in the period 2015 to 2020, it should keep inflation in the euro area also lower. That's what we saw between 2015 and 2020, because these are sort of a permanently lower stance of normal interest rates, as I think the picture, which I on purpose drew in the same scale, makes very clear. Sooner or later, there's a Fisher effect whereby the level of the normal interest rates perpetrates also the level of inflation. And that is, I think, one way we can see why inflation might be lower. So now I want to show my second picture and briefly say that to what I show and why that supports this. So what do these two pictures show? These pictures use data on options, and they show you the probability of a large inflation increase or a large inflation decrease for the left panel, which is for the euro area. This is the HICP over the next 10 years. And the red line is what is the probability of a large inflation increase, and the blue line is what is the probability of a large inflation decrease. For the US, I have, unfortunately, it's a little bit distinct, is over the next 5 years, US CPI. So let me first mention the commonalities. Once the pandemic hit, both in Europe and in the US, there was a very short blip that markets were thinking inflation will move to deflation, or there would be a high probability of a large decrease. That is the spike in the blue line. But then on both sides of the Atlantic, that probability becomes basically 0. For all practical purposes, currently, the probability that over the next 10 or 5 years, inflation will fall below 1 percentage point is extremely low. But where there's a difference for both sides of the Atlantic is that in the United States, the red line, namely the probability that inflation will exceed 3% over the next 5 years, shot up, and this number is currently hovering around almost at 60%. It's 58%. In the euro area, there's no such behavior. If you look at the red line, there's a slight uptick, but we are still at a lower than 20% chance that over the next 10 years, inflation will exceed 3.25%. And we also saw that just in Philip's, he showed ECB forecast for inflation, and he actually showed 1.8 and 1.9%, which is below the inflation target. And I think one can understand those differences in part as a consequence of fiscal policy, which I didn't comment on, but also of monetary policy, namely that in the euro area, there is a greater caution about raising rates, And the point I want to emphasize is a slower pace of raising rates is not being behind the curve and giving rise to very high inflation. On the contrary, over the longer run, this will lead to low inflation. In the past, it has led to inflation below target, but in general, it should lead to low inflation. All right, thank you.
Thank you very much, Stephanie. So actually, there was a neo-Fischerian element. I think when I introduced you, I wrongly said neo-Ricardian, right? Maybe that's why you laughed. But thank you very much. Let me go straight to Ricardo, and then afterwards we come back to the questions and all three of you. So yeah, you could step up. That would be perfect. Yeah, to the, yeah. Yeah, and that's all. Yeah, it's different, Ricardo.
That's right. That's true as well. A less famous one. How do I move my slides? Because this doesn't do anything. Oh, okay. Great. Well, thank you so much for having me. It's really a pleasure to be here. When I saw the title of the panel, I noticed that Volker had written new challenges. But at the same time, and that seemed adequate, as central banks have targets and have effects over things like fiscal policy, climate, central bank digital currency is an important challenge, so is financial stability. But then, of course, he has a panel on climate, he has a panel on fiscal monetary interactions, and I'm not sure that the challenge of central bank digital currency are the more urgent for us to speak today. So I wondered, is this a typo? Should you not have just said challenge singular? Because there's essentially one challenge now for the ECB, and that is inflation. The one that is, after all, in the Maastricht Treaty. Yet, I thought a little more and realized that plural may be adequate. Because after all, the challenges come not from having a singular focus on inflation, as a big challenge right now, but from the fact that, as well illustrated by President Lagarde's speech, there have been multiple shocks, plural shocks, the pandemic, the Ukrainian invasion, bottlenecks, changes in expectations, perhaps. And each one of them poses a different challenge, thus plural. But secondly, and as well secondly, because as President Lagarde emphasized through her intervention, right now, she wants to think of ECB policy. ECB policy is understood as optionality, gradualism, and flexibility, which I, in my academic brain, interpret as a tree with multiple possible forks, representing different options, where gradually we follow some paths in that tree, and where we flexibly may jump from some of those branches into other branches in the tree. That leads to multiple outcomes, not just at the end, but in the path, and therefore challenges of following which path to follow. In my notes, I will do a third dimension of plurality, if you want, which is to talk about the challenges faced by the different periods of the last 12 months. Volker did say from the pandemic crisis, which I associate with 2020, to the new challenges, and challenges in the sense that I see three stages that have, or three forms of challenges that have emerged in the last 12 months. And this is not an exercise in history, but rather all three of them are still very present and having an effect today. So my comments will be focused on those three and this plural. When it comes to the multiple challenges, periods, shocks, it is crucially important, though, to have an organizing framework. I spent last summer doing quite a bit of research on the 1960s US and the mistakes done, and perhaps the greatest mistake done that led to the bad outcomes in monetary policy in the 1970s was in some ways the lack of an organizing framework. There are different organizing frameworks one can choose, and certainly in academia we discuss which one is more adequate. But the absence of any is perhaps the one greatest sin. So let me orient my speeches using a Phillips curve framework, understood as inflation depending on three determinants, if you want, influences. A combination of expected inflation, an activity gap, and some cost push shock. To be clear, I do not mean this as a model, although a Phillips curve certainly is a part of many models. By itself, this equation tells you little insofar as we have deep measurement problems on the activity gap, on whose expectations, what expectations. Separating the terms is difficult, as will be clear also in my remarks in a little bit. What is activity gap? What is a cost push shock after all? A change in cost of production is a change in our ability to produce. Why star? Or is it instead a change in costs? A change in costs is a change in productivity. And finally, the causality here is expected inflation, for instance, certainly driven by current inflation. Importantly, this framework, though, is going to allow me to separate what are the relevant ingredients at play at different stages in time. And importantly, I should be taller to see my slides. And importantly, it also points to a very important fact, which is that in the long run, the activity gap and the cost push shock are gone. And all you're left with is with the expected inflation. Ultimately, controlling inflation is controlling expected inflation. They are one and the same thing. And note again here the reverse causality. This is not to say that whatever people expect is what is going to be the actual inflation. It's as much that as the other way around. Because of that, I'm going to focus on the challenges using this framework to think about ultimately expected and therefore long-run inflation. And a little bit complementing and unlike Philip's intervention, I'm going to focus on tail risks, the risks of deflation and high inflation. What are then the three periods? What was the first challenge that emerged? Post-pandemic. So I'm already, forget the challenge of the pandemic, just after pandemic. 9-12 months ago, the great challenge was that an economy in which we had had a very large recession, the red term in the organizing framework had become a very negative term, that had pushed inflation down, in a context in which, since around 2014-15, inflation expectations in the euro area seem to have become anchored below the 2% inflation target. The ECB ran the risk of being anchored significantly below 2, and that coming with the challenge of then having not just not hitting a target of 2%, but being below it, but also of losing room in order to flexibly respond to shocks moving forward. 12 months ago, March 2021, as inflation was increasing, one could say partly or greatly driven by that red term closing up, the challenge was to allow for that catch-up of inflation to happen, consider that base effect of below being one that should be reverted. The challenge is to remember the theory tells us that our stars, equilibrium interest rates, should be low and stay low for certainly a few more years, and that being caught in a liquidity trap would be dangerous. And history would taught us not to make the mistake of 2001 Japan and tightening too early, and in doing so having this anchoring below be too low. And therefore all of those arguments pushing towards perhaps a loose policy, and loose policy we had, insofar as if one goes by the level, the size of the balance sheet, or the size of interest rates, the looser monetary policy we had ever had. But let's go back, though, towards the end of the summer, all the way into Christmas. The challenge there, and I'm going to take here focus on our own panelist, Philip Lane, in his Hertie School speech just a month or two ago, I think, where the challenge, as he said, was that, well, with the recovery, we had a shock in the form of shocks to supply networks, bottlenecks there. The emphasis then was, well, filter out the relative prices, bet that these supply shocks are temporary, these supply bottlenecks, and therefore keep steady with loose policy. And indeed, that is what we had. But at that point, questions start emerging. A first important question is that even if it was the relative prices that were moving, given those bottlenecks, it is still the case that people form expectations based on relative prices. And what we're seeing already starting in the summer and later, and these data is from the Bundesbank theory of German households, was not only a creep up of expected inflation, but especially that, as you see there, the median caught up and exceeded the mean, which, if you remember your course in elementary statistics, meant that the non-parametric skew of the distribution was falling. In other words, we were going from a situation in which most households in Germany were expecting low inflation, with a few people being very pessimistic and on the right tail, to instead the average, the normal, the bulk of the distribution expecting high inflation and a few people being left on the left tail. A pattern that, as I argued 20 years ago with Greg Mank and Justin Wolfers, and again in the summer in a paper Brookings, is one that is often very dangerous and predates the change in inflation regimes, which is that when we observe disagreement and skewness moving in a way that signals this is not just the people at the tails moving, but the bulk of the population moving towards the tail, thus calling for perhaps gradual policy insofar as expectations may have been moving a little too far. Moreover, if these shocks, bottlenecks, are shocks after all to production potential, and I think there's a strong argument that that is what they are, then monetary theory says, actually, you should have had fairly tight policy. The call to say, let's have inflation rise because it's a bottleneck is one that's certainly arguable as a matter of theory. If there's a bottleneck, it means the natural level of output is low, the natural rate of employment is high, focus on inflation. At the extreme case, we'd have the divine coincidence that says focus ultimately on inflation. And yes, the economy will operate at a lower capacity and employment will be higher, precisely reflecting the bottlenecks. Bottlenecks are not cost-push markup changes per se. They are changes in productivity, ultimately. Finally, what is the challenge today of the last month? The challenge of last month is we have a large, maybe persistent energy shock. One interpretation is that this is indeed another version of the epsilons. There you would say, well, focus on the core and especially avoid making the classic mistake of focusing on headline inflation, tightening too much, and causing a recession, which research has highlighted was a repeated mistake that central banks have done. This says, go gradual. Tighten, but go gradual. Instead, though, if you think that, insofar as you think that the shock persists, note that monetary theory also says, and quite clearly, that you want to trade off higher inflation for smaller recession. Well, the economy right now doesn't seem to be in a recession right now. Inflation is definitely way above target in some ways. That would say you really want to tighten. The challenge is, well, there's a trade-off. It is inevitable. We should be tightening because inflation is much further from our objective than in some ways economic activity is, and we may think that those costs are convex. But, and thirdly, if one looks at the expectations, the ultimate long-run determinant, one sees worrying signs of not just a re-anchoring at the right level, but an anchoring when one focuses on tail risks. On the left-hand side there, I have histograms from inflation options of the 10-year expected inflation over the 10-year horizon. What you see between January of 2021, June of 21, and November of 21 is indeed a anchoring around the 2%, a re-anchoring in the right points. But and this has come from a paper that I released 2 weeks ago with Jens Ilscher and Alon Raviv. But when I redid these estimates incorporating the January and the February data, last night or over the last few days, what I see more is starting to be a building up of tail risk on the right side. And indeed, on the right plot, I show for you not the 10-year, but the 5-year. And my numbers are different. Stephanie showed some version of, I think, the same concept, and my numbers are very different from hers. I don't know where hers come from. Mine come from a paper 2 weeks ago, so you can check that. But these ones, crucially, are different in that I'm looking here at the 5-year probability, not just the next 5 years. That's important. And it's important also just to do quite a few risk adjustments to the options data and some cleaning to the options data. But here's the probability of high inflation potentially in the Eurozone. And, and I should have said earlier, and here, that was from the same data, there was a serious risk of deflation. And that's what I had different, from Stephanie, which is I find that the deflation risk is still very present in the options data and has not disappeared. What has disappeared is the next 5 years. Stephanie showed you the green line, but the blue line is the 5-year. And that one has not disappeared. So there's still a clear risk of deflation risk. But here, focusing on high inflation, in the US, for now 6 or 9 months, there was a clear increase in the probability of a high inflation shock. In the euro area, when I released my paper two weeks ago with data till November, there was no such risk. And yet, when I added the last 2 months, I see a pattern that now seems to be following the US with a 6-month lag, with a significant increase in the tail probability as reflected by options. That calls for a hard tightening. Why? Because it is a result of inattention theories that we have these hockey stick type relations of expectations. People don't pay attention, they don't think about the right tail risk until they do. But when they do, things shift quickly, and as they shift quickly, one needs to re-anchor those long-run expectations back. To conclude, these are not 3 different challenges at different times. These are 3 different shocks that are hitting now. The first one says, be vigilant about deflation risk. And I disagree with Stephanie. I think deflation risk is a serious problem still in the euro area, not in the next 3 years, but as a regime, there still seems to be, I think, the risk of tightening too fast and being stuck with inflation, with the deflation trap for many, many years to go. But there's another shock that says that, careful, because if you, at the same time, tighten too fast, given the movements in expectations, or don't get the right amount, we may end up with a recession, a 2023-24 recession, because of excessively loose policy during this year, that then requires a tightening the following year. And then there's a third shock that says, be even more careful, because not only there's a risk of a recession in 23-24 to correct potentially loose policy now, but there's a risk even that we will not get there and transition to a high regime, to a high inflation regime. So I see the path as being very challenging because I see indeed these different shocks, and I find it difficult to have people say that they think it's all one or the other, for I see the uncertainty at a very high level. Or to conclude, I want to conclude with the analogy that I came up with from listening to President Lagarde a little while ago. If I think about the ECB as being a squirrel that seeks in climbing a tree the nut of price stability and achieving the Maastricht Treaty, like President Lagarde said, it now faces optionality, and optionality says follow the branches where there's more thick branches, so you can keep the option of changing. Be gradual, such as a squirrel is hesitant as it climbs one of those branches and keeps on reassessing what to do. And stay flexible, insofar as you may indeed have to jump from one branch to the other as you realize where the nut is. But more pessimistic, and sadly, maybe I'm just more of a pessimist, my contribution to the panel was to say that among these different branches, I see one or very few that will lead to the nut, and many that can lead to very bad outcomes. And as a result, they will take extremely deft monetary policy over the next 12 months to actually achieve that path. And I see very high risks both on the upside and the low side. So I hope that, like Volker, I'll be invited here in a year or two, and I can thank President Lagarde and the following members and their other members of the Governing Council for having achieved that path. But I think the risk is extremely high of failing on both directions. Thank you very much.
Well, thank you very much, Ricardo. So given we've lost the lead we had in time, I think rather than doing, there's some disagreements, and so we can have reactions within the 3 speakers. But before doing that, maybe let's collect the first round of questions. So let's take the first 4 questions on the list, and the speakers can make some notes. Then we have a response by the speakers where they can also make one or the other remark regarding each other's contributions. Okay, so I have Jörg, Zeuner, Dirk, Schumacher, Krause, and Gertjan, Vlieghe. Maybe in this order you can ask your questions and we make notes.
Yeah, thank you very much for opening the Q&A session. I would like to focus my question more on the medium term. When I saw the inflation projections for 2023, 2024 from the ECB, I am a little bit concerned, and I was wondering how much of the challenges that we have mentioned have already been sufficiently factored in those medium-term projections for inflation. We have been, Ricardo, you talked about shocks, and we saw the analysis of these shocks, the macroeconomic impacts. We are very good at assessing those shocks and very good at assessing those impacts in the short run, but isn't challenges the right term? Because in the longer run, there are some really major structural shifts going on. I'll mention just two of them. I think we're now, as a European economy, very much caught in the power game between the US and China. We're the entire corporate sector is rethinking its supply chains. We have an endless row of papers who have shown the productivity effects of globalization. So if we reverse this now and go closer to home, I wonder what that does to the real equilibrium interest rate in the medium term and inflation. In my mind, inflation is going up on a structural basis and the equilibrium real rate is coming down, meaning productivity growth is slowing, if not reversing. We had the other challenge of demographics. I'm not going into this in detail. The effects here are a bit more disputed. Is it increasing inflationary pressures and reducing the equilibrium interest rate, or the reverse? We certainly have more investments. A while ago, I would have argued those larger investments over the next couple of years will increase productivity and lower inflation. Now, most of them are going into energy, food, and the military. I'm not so sure anymore if that isn't inflationary and more a drag on productivity. So my question is, where do you see the real rate going, the underlying real interest rate in the economy, and how much of this and the inflationary impact that I think remains of many of those structural developments, how much does this have an effect on inflation in the long run? How is the ECB building this in its model? And maybe to the rest of the panel, do you share the view that those structural challenges need to be included? And doesn't this mean that the ECB should prepare markets and the public for higher inflation for a longer period of time? What happens the next month will happen. I don't think monetary policy is going to be able to change that.
Thank you. I would have a question on inflation expectations, of which we heard, and I guess we all agree, are very important. Do you think there's evidence for that or not, that the importance of inflation expectation changes over time? So not that inflation expectations are rising, but that the coefficient in front of the Phillips curve changes over time, in which way, and how would we know in real time? And if it, say, increases and inflation is increasingly determined by what inflation expectations do you think there could be a situation where the ECB would then be forced to tighten no matter what, regardless of what the output gap does, and so on and so forth? So, yeah, is there evidence for that or not? Thank you.
Thank you.
Yeah, thank you very much. I have questions that probably relate to all presentations, and Ricardo has shown us a Phillips curve, so that helps organize the discussion. I mean, there's an expectation term that the output gap and the cost push shock, but what I missed in the discussion was statements about the persistence of inflation. I mean, there was once a discussion about intrinsic and extrinsic inflation persistence, and it seems like the belief is once the shock is gone, then inflation will be gone if only inflation expectations are anchored. But there may be a lagging effect. I mean, in Europe, I think wages probably haven't adjusted that much yet. Wages are less flexible, but that may come. This wage changes, real wage gains, bargaining may become stronger. Rents are also more flexible in the US. So maybe in the US, the inflation was very high because wages and rents adjusted very fast. And that's going to come with a lag in Europe. Maybe that's consistent with Ricardo's picture that inflation looked like it would pick up soon. And then also maybe that explains the puzzle that Stephanie was mentioning about the low inflation yet. Maybe it's still coming, but I also believe there must be some Fisher effect, but we still may see negotiating parties in the unions and workers will demand higher wages in the future to come. And that brings me to the optimistic forecasts that Philip showed. Next year, everything seems to be fine again. We are at 2%, but doesn't it take a while until these wage bargains feed into inflation? That will create second round, third round effects that are there to last. Maybe I'll leave it at that for the moment.
Thank you.
Thanks.
And Gertjan?
Thank you. My question is about the risk management approach to monetary policy. So there's an extensive academic literature that says that if you're near the effective lower bound, then you want to wait a very long time before you lift off to make sure that the liftoff is durable. And one interpretation of the ECB strategy review is to sort of encode that kind of thinking. But there's a second part to that academic literature which says that once you've reached the point where you lift off after you've waited a very long time, then you need to go quite quickly because you've waited an extra long time to account for the downside risks. And so my question is, now that the labor market is tight and inflation is above the target, inflation expectations are anchored at the target, not below them anymore, are we now moving to that fast normalization stage? And if so, how does that square with the big emphasis on moving gradually?
Actually, before going back to the speakers, let's see, is there already a question or something voted up on the questions online? So let me just remind you, you can ask questions online. You can also, I believe, vote on them. Is that correct? Yes. So please take your time to write them up, and we'll take them in the next round. You alert me to that from the technical side if we have some interesting questions there. And also then maybe let's take one more question out of the room before I go to the speakers. If anyone wants to raise his hand, have a microphone? Not yet. Then just keep in mind, oh, there's one. And then if there are other people, okay, well, it's right next to you, so maybe Daniel, both of you quickly. Then we go back to the speakers. Okay, Daniel Gross.
Thank you very much. My simple question is to Philip Lane. Given the central importance he puts down for the projections for price stability in the forecast of the ECB, the question is what kind of confidence you can have in the models or frameworks which you are using right now to forecast inflation 2 or 3 years out. Could you describe a bit what mechanisms do you see at work which will bring inflation down to 1.9%, as your forecast seems to imply?
Okay, so we go to the speakers. So back to Philip Lane. Let's start with, let's do the same sequence.
Okay. Let me first of all generalize the challenge, because various people were asking questions, and of course I'll try and respond about the ECB, how the ECB thinks about all of these analytical challenges about what to integrate, how to form a medium-term view. Well, regardless whether it's the ECB, it's other forecasters, or it's individuals, all of these need to be taken on. And I think I would divide the question into 2 parts there. One is, how should the whole professional community of economists think about these features? And then relative to that, basically benchmark of professional standards, is there critique? Is the ECB getting it wrong somehow compared to that professional standard? So let me take on a few issues here. I mean, essentially, when we think about the medium-term implications of structural change, well, I mean, I suppose that there's long-term, because quite often when we think about structural change, a lot of the analysis is basically decade by decade. So if you try to work out what is the impact of globalization on costs, on productivity, what's the impact of digitalization, I'm pretty sure when I open a journal 20 years from now, they're going to emphasize the kind of low frequency component. But of course, for us, I mean, a lot of this boils down to is how quickly will any relative price movements, is it going to be super gradual, or is it going to be so sharp that it actually makes a difference in terms of year-by-year inflation rates in a significant way? Then a second basic issue is, with all of these factors, when they operate basically in conflicting ways on demand and supply, especially in an uncertain world. So typically, there's like a triple in terms of structural changes. One is globalization or deglobalization. One is the carbon transition, but third is also digitalization, which maybe will mitigate both carbonization by providing lower carbon ways of producing, and also with respect to globalization by, of course, if some supply chains need to deglobalize, digitalization allows services trade maybe to become more viable as an alternative to domestic suppliers. So, I mean, I think we would spend a lot of time at the ECB. We have a kind of supply side kind of teams working on these issues. And definitely we'll continue to work on those issues. But as Ricardo said about not being so certain about the, what is the impact of any of these on net, I would tend to say this is something we need to look at continuously rather than making a big call about their net impact. Or start, it's an interesting issue because, coming out of the pandemic, and again, depends what is your counterfactual. I mean, with climate change, for example, the counterfactual of not investing in the green transition is a pretty dire outlook because so much of the kind of economic structure is going to be made obsolete in a world without the transition. So compared to that structure, investing in the green transition will be a plus for potential output. But of course, it's compared to having no climate change to worry about. There is a damage control exercise here. There's a big issue about risk. I mean, what are we seeing? We're seeing also these structural changes, but maybe as reflecting some of the questions now about how can we model anything, there's also a general issue about I really don't know where the world is going. And in a world where I really don't know where the world is going, the precautionary savings motive is a fundamental issue. How much of the coming years is going to see a lot of precautionary savings? And maybe, again, going back to some of the lessons from the pandemic. In the pandemic, that was basically counterbalanced by a pretty big, significant step forward in fiscal activism. And, that's one of the recipes for dealing with secular stagnation with low or star is, if the private sector is very hesitant about investment, will the public sector do more? And again, I think that's a very big issue to make. So in other words, I'm not going to be very conclusive about the impact of structural change beyond recognizing it's something we need to look at, but also to look at it on both sides of it, the supply side implications, but also the demand side implications. On inflation expectations, which was asked about, I mean, and I think a lot of what Ricardo says, we have to pay attention to. Of course, I mean, to me, what we had was inflation so low that inflation was not a salient factor for a long time. And essentially, if people believe inflation's sticky around 1, or, and again, if they kind of ballpark it, just basically, it's so low, I don't need to take it into account in my wage negotiations, in my pricing decisions. There is a self-fulfilling aspect of being in a sticky inflation trap around 1%. Whereas now, and I showed that in the decomposition of the 5-year, 5-year, where basically people were not worried about inflation risk. Now they are more worried about inflation risk. And I think that has to be true. It has to be true. Inflation everywhere in the euro area is now much more salient. It's feeding into firms who need to make pricing decisions. It's feeding into wage negotiations, into savings behavior. I'm bombarded every day with people asking me, just friends and family and so on, about this basic issue about how do I haven't had to think about inflation in 15 years. How do I think about it on all fronts? But of course, the big question is the persistence mechanism. I'm generally would be someone who would give a lot of weight to a lot of extrapolation. So that was a curse when inflation was very low. It's also a risk factor now when inflation has been high. So extrapolating in terms of the future inflation dynamic, I would give a lot of weight to. On the other hand, there are such things as level effects. we think of some of the energy prices as basically determined in levels. And so, the question is, in terms of what a reasonable conjecture is for this steady state growth rate of energy prices. And bottlenecks, I mean, I think I'm going to, say that quite a lot of them we do think are temporary interruption. You can definitely model it as a temporary decline in productivity. But, a lot of last year we spent time thinking about the car industry and saying, well, car industry output has really plunged in Europe because of bottlenecks. But look, in the end of last year, there's big recovery in car production as some of those bottlenecks got sorted out. So, I mean, from a monetary policy point of view, it's very different if you think it's basically less supply now, more supply later on, compared to less supply now and less supply later on. So, again, in the end, and this is why the ECB has a lot of people working on all of these issues, you have to get a little bit granular to get into it. But having said that, let me agree with Ricardo, you do need an analytical framework. So Ricardo is starting off with saying, well, let's keep some kind of overall narrative and framework in place. I think is quite important. I mean, Daniel raised the issue about uncertainty. How can we, first of all, we have to, we do have to have projections. It's important that our policies are robust. And this is why we do have this state contingent forward guidance now. I mean, but one of the big issues is the models are basically generating a fact that under some scenarios there's upside risk, but also in other scenarios there's downside risk to inflation. So in terms of the policy setting, when you have uncertainty, considerable uncertainty on both sides of the projection, honestly, that's the way we proceed. These are point values, but when people say, "Well, you're uncertain about it," yes, of course I am. But let me make a couple of points. One is there's the uncertainties on both sides, and two, the forecasts get revised every 3 months. So monetary policy, as we've been showing in recent meetings, when the kind of outlook changes, when the narrative needs to be adjusted, we will adjust, because we're not in a very stable situation, and that's going to be continue, I think. And what we've said in the policy statement last week was this is essentially it. We don't know for sure where the outlook is going, and to factor both upside risk and downside risk to the baseline does mean we need to be agile. So let me stop there.
Thank you. So let's go next to Stephanie.
Yeah, hi. Can you hear me?
Yes.
I think so. Okay, so let me also say something to structural change. The first question, why would structural change be a challenge for a central bank to manage in terms of inflation? I think structural change brings with it potentially big changes in relative prices. We believe that the pricing system always has a problem to adjust quickly. We believe prices are sticky. And in particular, if structural change will bring with it a lot of relative price changes, and we also believe that it's much easier to raise a nominal price to lower one, then structural change should bring a bias towards higher inflation. So if we have more relative prices that need to change, it will be that more relative nominal prices will have to go up. And I think that is something that probably the central bank would have to accommodate, because we want to have the efficient relative price. And so I don't know if that is where your question came from, but so I think structural change looked through the lens of a structural inflation theory of Oliveira, namely that all relative price changes are brought about by the nominal price going up will lead to more inflation. And that is not something the central bank should then be leaning against. That will be just something that is very efficient to tolerate. But it's not going to be a persistent increase in inflation. It's more of a level effect. Then there was a question about inflation expectations and also about inflation forecasts of the ECB. If you remember the various forecasts that were made over the past 15 years, how inflation of the ECB would always go back to 2%, and then it had to be said, oh no, actually we missed it, we are not going back to 2%, we're going to keep the nominal interest rate longer at 0, and we are now forecasting again to go back to 2%. There were all these fan graphs that were like shifted from each other going up. I don't know if central bank models do at all have the possibility to give an answer that is different from, yes, we are going back to 2%. Most central bank models have hardwired into them that inflation has to go back to 2%. And so I think that also answers the question that was asked earlier, how do you come up with inflation 2-3 years from now to be 2% or below 2%? I do not know how much flexibility there is given. But if nominal interest rates remain so low, and we just heard today from various ECB members that major tightenings are not in the card for the ECB this year, I think it's a reasonable assumption that inflation stays low. In terms of inflation becoming very sticky, so I think we have learned two things that maybe people were a little bit surprised by. We have now had 10, 15 years of very low inflation, and maybe we didn't realize how much people dislike inflation. Here in the US, there is such a backlash, such an anger against inflation. So it makes us understand a little bit what a great good the central banks have created over the past 15 years of having very low inflation, and that is something that citizens or everyone in society really values, and I think it should make the central bank realize that it really has to defend that goal and that it's something very valuable. I think Michael Krause asked about what happens to inflation expectations, and is there maybe a slow shift? I think all of you read the newspaper probably more than I do, but there are all these anecdotal evidences about in union negotiations, is the contract already phrased conditional on inflation? So is there any evidence that in union negotiations there's indexation? And from just not scientific evidence, like looking at all the bargainings, the newspapers always, at least here in the US, point out that surprisingly these indexation clauses have not returned to full force, which is interpreted as people not thinking we will move to a permanently higher inflation regime. All right. Oh, yeah, I wanted to, if there's time, but we're almost out of time, I wanted to know where Ricardo thought there was an inconsistency between my numbers and his, because I didn't really see it, and then I would be happy to answer to how I made the computations and what the possible source of inconsistency could be. But just to make the economic point I wanted to make is that in both the US and the euro area, the probability of missing the inflation target on the low side, namely the probability of a large inflation decrease, has basically, to a first order approximation, vanished, whereas the probability of missing the inflation target on the upside by being more than 3% has risen both in the EU area and in the US, but it has risen much more in the United States. And I was trying to give a reason for why I think inflation in the US is higher and inflation expectations in the US is higher, and I think it has a big fiscal component, but it also has a big component that comes from monetary policy itself, namely that in the EU, there seems to be less of a desire to rapidly raise the policy rate. All right.
Okay.
Thank you.
Thank you. Ricardo?
Okay, let me try to be concise. First, on Dirk Schumacher's question on the importance of expected inflation. At the two extremes, we can answer that with some confidence. When we're going through hyperinflation, everything is expected inflation. And we think that what drives expected inflation tends to be fiscal policy measures. That's one extreme. At the other extreme, when we live in an extremely well-anchored regime, as arguably we did over the last 20 years pre-pandemic, then expected inflation pretty much doesn't matter at all because it's 2% plus noise. And if anything, responding to measures of expected inflation, all it would do is introduce noise in monetary policy. You can take it pretty much as anchored if you want. Note that you want a distinction between variability in the variable as opposed to a coefficient. And I'm not really quite giving you that. That's hard. But simply I'm telling you in terms of what accounts for the variance of one versus the other. Right now, and I was trying to point to, is that we are a bit in that turning point where, and I think Philip also just said this, where expected inflation went from being, if you're reporting to the Governing Council in 2016 or 14, it will be maybe 10% of the meeting, and let's spend 90% of the meeting on the epsilon and the y minus y star. Now it should be at least a third of the meeting, what's going on to expected inflation. Instead of 35 measures of labor slack, let's look at 39 measures of expected inflation, because I think it is accounting for a big part of the inflation we're seeing. Why? Because of what I described as this essentially change in regime of attention regime where people are paying attention to inflation, and those expectations are a way for us to measure it. So I think it does vary, and it's a very opportune question because I think it is changing. I would not be, if I was a monetary policy maker 3 years ago, I would not look at expectations that much. I would look at them, like I said, a lot right now. Second, on the persistence of inflation, you are right, Michael, when you note that inflation tends to be more persistent in Europe, or at least that was a fact all the way back from the 80s and 90s when we actually had some variability. Maybe it's still there because we haven't had that much inflation. It's hard to know, but for the arguments you said. At the same time, let me note that partly because the war in Ukraine has a bigger impact on our economy, we are going to see some very large exchange rate movements. And what I know from small open economies, not the euro area, is inflation tends to be less persistence there because you have a lot of more jerking up and down on account of just exchange rate effects. So I have those two competing effects, so I'm less confident that it's going to be very persistent than not, because I can also see very large exchange rate adjustments that could bring inflation up and down very quickly. And you're already seeing this in some of Philip's pictures with the oil prices, which are a mix of the supply shock as well as just the exchange rate and how much it will change. Especially if, as Stephanie noted, we see a divergence of monetary policy with the Fed reaching 1.75 and the ECB staying at minus 0.5 in 6-9 months, as is possible. That seems to be like a war. Between that, Ukraine, what happens in other regions of the world, China, that seems to be like a world with a pretty volatile euro exchange rate. And that will have a big impact, I think, on inflation. Third, Jan, on risk management. And so let me, in some way, it gives me a great opportunity to kind of clarify a little bit some of my comments, which was that I think we went from a world in which deflation was a big concern for the ECB, the deflation risk. Here thinking, risk management, I understand it as look at the tails, less on the mean. Let's really think about the bad scenarios, which was very much what I was trying to do. So I appreciate that question because that's exactly what I was trying to do. Points I tried to make was that the deflation risk has been there. I don't think it has disappeared. It has diminished, but it hasn't disappeared. But what's new is there's now high inflation risk. If I'm a risk manager, an extreme risk manager, that would call, as I try to do with my little colors, for significantly tighter monetary policy. Now, already before, and certainly in the nearby future. I don't think it is just that the probability of deflation has gone low and that calls for gradually slightly tighter policy. It's also that now there's a significant probability of a high inflation. If you're balancing the two out, Jan, and you're an expected maximizer, I think a policy conclusion that says I want, forget my cheat sheet, optionality, gradualism, and flexibility with very little movement right now makes perfect sense. If you are a risk manager, then I think that the change in tail risks would call for much tighter policy, as I said, in the recent past, in the present, and in the near future. And so thanks for that question, because I think it really encapsulates why we can agree with the objective diagnosis, but disagree with what policy should be right now. Are you an expected person, or are you a risk manager, a tail person? And I try to complement Philip's expected view with a more tail view, which accords exactly what you said. And finally, very briefly, Stephanie, I expressed myself poorly. What I said is that our numbers, I think, agree, but you're showing 5-year deflation probabilities. I plotted in my plot both a 5-year and the 5-year. And what I argued was that the deflation regime trap scenario in Europe, as in the US, became very low over the next few years, but is still there as a problem of the regime, as reflected in the fact that the five-year probability did not change. That's why I said like an inconsistency. Not just in the sense of different numbers, but in the sense of you're focusing on the next 5 years, and I was showing yes, but there's the 5-5, i.e. the regime side. And that's, anyway, that's a small point. Sorry, we'll talk later.
Okay. So a quick round of brief questions. I have some online. Let's show those first. Then I have Harry Stellas, and then maybe take one or two more. So, but very, very brief. So online, we had Petra Geratz asking, recent policy decisions have led to much stronger rises in 10-year government bond yields in Italy than in Germany. Apparently, financial markets are not persuaded by the flexibility in reinvestments announced by the ECB. So how does the ECB plan to address this challenge? Jörg König, in the past, the ECB constantly overestimated inflation dynamics. What does the ECB make confident that its inflation projections are more accurate this time? And Franz Seitz at Philip Lane, it seems to me that you're mainly arguing in statistical terms, base effects, rises in special components of the HICB. What about economics in theory? What about labor markets, globalization, climate change, and the necessary price increases of energy? Then we have a question. So let's keep those up so speakers can look at them. But let's go directly to 2-3 questions from the floor. So Harris, yes? Let's keep them short, though.
Thank you, Volker. This is a short but rather loaded question. And it is addressed at Philippe. Is my interpretation accurate that the ECB thinks that it bears no responsibility for the current inflation because it came out of the blue and it was due to external factors and has nothing to do with its policy? And also going forward that there is no need to do much because inflation seems to be temporary and also because we live in a world of uncertainty. So no contribution in the past and no contribution to lowering. Is this an accurate reading of your comments?
Okay, thank you. And maybe, okay, let's have your question and then Krishna Guha. So let's start here. Yeah. So quickly state your name again.
Thanks, Christian Kopp with Union Investment. I have two questions to Philip Lane. Philip, looking at it from afar, it seems to me that the storyline is morphing a bit. Yeah, started out by saying that inflation is transitory, and you don't have to do anything. Now the story is, well, it's not transitory, it's persistent, but inflation expectations are in check. And now you're saying, well, inflation expectations not really in check. 5-year is moving up, but I have two affine term structure models, which are showing that it's only related to an inflation risk component and not really to inflation expectations. So my sense is the storyline is a bit blurring here, morphing over time. And I'm wondering whether you're becoming less confident in your view that inflation will come back down again. And second question briefly, are you not concerned that the long end of the yield curve may blow out? And are you maybe overconfident in the stock effect of QE? And what can we do to contain sort of hockey stick effects at the long end of the curve once your asset purchases stop? The Hungarians, for example, are keeping asset purchases in place even while they're hiking rates. Thanks.
And Krishna?
Thank you very much. Krishna Guha with Evercore ISI. So I want to ask anyone on the panel who'd like to take this, particularly Philip. The ECB's policy communications have emphasized in response to this complex set of shocks, the idea of normalization, but distinguished between normalization and tightening. So I'd be keen to understand a little better what the difference is. Does normalization, for instance, simply mean returning to a more normal setting where tightening means going beyond neutral? Or is there any other dimensions to this? And when we talk about normalization, is it pure stance normalization? Or is instrument normalization also a relevant consideration?
And maybe one last question here on your left side, on your right side.
Thank you, Chris Crow from Capula. When you look at the inflation dynamics in the US and Euro area, particularly looking at underlying inflation, it seems to me that the Euro area is very much moving along the same trajectory as the US, although it's perhaps a little bit behind, but maybe not that much behind. But when you look at the policy trajectory, the ECB is still stressing gradualism while the US is moving ahead. The Fed's moving ahead with quite aggressive hikes over the next 2 years. So I was wondering, especially directed at Philip, how we can sort of rationalize that divergence.
Thank you. So maybe let's reverse the order. Let's give a brief response for Ricardo and Stephanie, and let's leave a little more time for Philip. There were a lot of questions also to him directly. Is that okay? So let's start with Ricardo and then Stephanie, and then leave Philip to close up.
Oh, I have very little to add to say to Harris that inflation is always ultimately about monetary policy and how monetary policy responds to shocks. So I think whatever inflation you observe, there was a shock and you chose to respond to it or you chose not to respond to it. But absolutely, I think, and that is a very important, even democratic lesson, that we should hold central banks accountable for inflation, and they should explain why they let inflation, why we had inflation rise, and explain in terms of their mandate and in terms of how they traded off against the other goals, namely dual mandate if we're talking about the US or others. But I thank you for raising that, because that is absolutely always important. Just because we're talking about shocks, it doesn't mean that the central bank's response does not then ultimately affect the inflation outcome. And I think that's just a very, very important thing. I'll just say that, because I thought the other questions were really more to Phil and policy.
Thank you. And Stephanie, do you want to have a quick remark?
Yes. I think all the questions were addressed to Philip, but highlighting a little bit also the theme of my presentation, it was that there's a different monetary policy course in the United States than in the euro area. So one person in the audience asked, is Europe just a year behind the US and inflation is going to come? My main point was to say that even though the euro area seems to be intent on the path that rates will be raised later and maybe not as high, I do not think that per se, also maybe that speaks to Harris's question, is the fuel of more inflation. I think that what the ECB has shown over the last 15 years, that it is very comfortable with a regime of very low nominal interest rates, and why not in the short run, but over the long run, if that is understood, that should keep a lid on inflation. Okay.
Thank you. So Philip, to you, and I think take your time.
Okay, thank you. So the question of in what way is the narrative changing? I mean, it's probably best to go quarter by quarter. Until in September, we still had a 2-year ahead forecast in the mid ones. And so the narrative, which we had throughout the pandemic, is we're working hard to restore the pre-pandemic path, which did have 2-year ahead inflation, I think at 1.6. That was still the narrative until September. Now, there's a pretty big change in the narrative between, in line, by the way, with the change in the projections, going from September to December, where essentially the 2-year ahead forecast went from 1.5 to 1.8. 1.8 is much closer to 2%, not quite there, and with two-sided risk to it, not quite there, but a big jump compared to 1.5. And that is why we did have a plan to essentially have a pretty big downshift in asset purchasing when you look at PEP and APP together. And now here we are in March, where there's a further revision in the outlook, which again, there's a further getting closer to 2%. And maybe, again, thinking about, well, if you're not a fan of looking into the black box of the model, if you look at some basics, going back to Ricardo's framework, look at the evolution of inflation expectations, and also a pretty big one, because of course, I think it's going to show up in every model, is how tight do we think the labor market's going to be? And what is our projection for wage dynamics? And, those are moving. And I suppose this is the big thing, is inflation is now at 5.9. We are, saying that the medium-term outlook is changing. But of course, compared to the current inflation rate right now, whether, we're talking about 1.8 versus 1.9 versus 2 or whatever, that's a tiny fraction of the overall inflation rate right now. So it remains the dominant narrative that most of the 5.9 we're seeing will fade out because there's a lot of level effects out there. And that remains the basic split. And that goes to I think what Krishna and some others are asking is when we have a medium-term perspective on inflation. I mean, you can all make your own calculations. Let's imagine we try to deliver 2% inflation this year. What would be the scale of the tightening we would have to do to make sure the overall was at 2 when energy inflation, which is mostly imported, is at 32%. So when we take a medium-term perspective, and if we think medium-term inflation under the current projections, which include the kind of market curve for future interest rates, will basically deliver the neighborhood of our target. It basically says that we don't think beyond that, beyond what's built into the forecast, which is based on market rates. So that kind of narrative where inflation is going to fade back to 2%, conditional on essentially a degree of monetary normalization, not keeping in place QE, not keeping in place indefinitely the policy rate of -50, and so to me that's normalization. It is the message is we think the inflation target will be delivered so long as we do our job, as opposed to a scenario where we assess it's become evident to us that there's a risk of that inflation will not return to our target unless we engage in a tightening campaign. And that's my working definition of the difference between normalization and a tightening episode. Do we think the current scenario means inflation will under normal conditions, get to our target without having to have a campaign of having to cool down the economy? I mean, it's a very interesting question Harris asked, which is, it goes back to, we did say, and the President said it, and I said many times, is there has been a faster than expected recovery in the global economy because of policy support. Essentially, central banks stabilized financing conditions, and then fiscal did a lot to support the recovery, to keep many firms and households in good shape during the pandemic. So there was a faster recovery in the world economy than expected. And I don't, and maybe that's an interesting question to ask under counterfactual, where because I showed you those projections where unemployment we feared was going to be high for a long time, and now that's not the way it turned out. So under perfect foresight, what would the policy path have looked like? But that's an interesting project for someone to do. Those of you who ask about the prospects for essentially the kind of uniformity of financing conditions across the euro area, obviously we always pay close attention to this. During the PEP period, of course, there was so much monetary support that it was not a first order issue. But clearly, when we take away that level of monetary support, it's an interesting question. But this is why we are emphatic. We were emphatic in December. We paired the end of the net purchases under PEP with a general commitment to flexibility in our monetary policy when appropriate. And the President basically repeated that today. So that is absolutely true. It's, we say in particular, it includes the reinvestment of PEP, but as the President emphasized, it could include new instruments. So there's a kind of a general, recognition in a monetary union. This is something that we obviously have to pay attention to, but of course, what exactly is the best way to handle these things is very context specific. So let me maybe stop there. Oh, maybe the last thing, just on the US comparison. I mean, look at the difference in some basics in terms of overall levels of demand, chronic current account surplus region versus chronic current account deficit region, look at the level of spending compared to pre-pandemic, look at the labour market, where essentially the labour market in Europe has basically been much less damaged, honestly, than the US labour market in terms of participation rates. There's every factor directionally, of course, is present in both situations, but quantitatively, I mean, I don't think it's that hard to make a case for a significant difference in underlying dynamics across the two areas.
Thank you very much. So we're at the conclusion of our panel, and we'll reconvene at 1:45. So please join me in a round of applause to our speakers and the questions.